Welcome to the Eagle City Multifamily show, where we talk about how to get into apartment investing and how you can invest in apartments. But first of all, this is not legal or financial advice. It is simply professionals sharing how they got started in apartment investing and what they are doing now. And today we have a fine guest, Lisa Landry, on the show. I've seen a lot of Lisa's work, and she also has a business of interior decorating and design, and she'll tell us more about that in just a moment. And also invites others, people like you and I, to invest in deals and how that is becoming more available to people like you and I. So, Lisa, would you mind telling us a little about how you got started in apartment investing and a little bit about your background?
Sure, I'd be happy to. Thank you for having me, Herb. This is super fun. Looking forward to it. Well, I started my interior design firm. It's called Landry Designs about 20 something years ago, and really just worked on residential projects and then started adding commercial projects. But 10 or 12 years ago, a property management company for multifamily contacted our team and said that he had seen our work and he liked it. And he managed 45 apartment communities, his office did. And they had 10 of them that needed major CapEx work done in that 1 year and wanted to know if we would help with that. And so, I said, well, I have to be honest, we've never worked on multifamily before, but we're happy to come take a look. And went and looked at these properties in Dallas and realized pretty quickly that they weren't nice, fancy apartments. They were much older apartments, what we would consider B and C class apartments. And they really just needed freshening up. They actually buy and hold the groups that own these. And so about every 10 years, they completely redo things. So we assisted with those 10 that year, redoing the leasing office, the model units, exterior paint, landscaping, kind of, redoing the whole image of the properties. And our team ended up photographing 5 of them. We entered them into an international design contest that was judged by magazine editors from across the country. And they did not have a multifamily category. They just had a commercial category. So we entered them in that, and they swept that category, and they won first, second, and third place just for, these B and C class apartments. And we were so excited and so surprised. And so we started doing more and more multifamily after that. And now our team, that's one of our specialties. We're known as the interior designers of multifamily investing, because I'm an investor also. And we do multifamily projects across the country. So that's kind of how we got started in it. We've done probably 200 properties now and continue to add to the services that we provide. And our main criteria is how can we increase the value of this property? So that was sort of my first foray into it. But then a few years ago, I started thinking about the stock market and how volatile things were, and decided to figure out what else I could do that might be a little bit more stable. I have other real estate investors in my family, and they sort of all invest in different things. Some do single family homes, some do assisted living. And I started researching asset classes to invest in if I wanted to take some money out of the stock market, and came across multifamily. And I really had never thought of investing in it, although I'd worked with property management companies for all these years. But I thought, I'm going to research this and see. So I started listening to podcasts like yours, going to in-person meetups, reading every book I could get my hands on, just trying to educate myself as much as I could, and realized, oh my gosh, this is where I feel comfortable. This is so much more scalable than single family homes. And so about 3 years ago, I started investing passively, and then ended up last September being a general partner and have a $10 million property that I'm one of the asset managers on. And we're actually under contract right now for a $25 million property. So that's kind of how the journey has gone.
Wow, that's amazing. That it's somehow the scalable aspect of apartments, like you mentioned, it's scalable because of several reasons. There's so many, say, houses in one address, one location, one, like in several buildings around one apartment complex. And that's the great scalable aspect of apartments. It's not like single homes; they're all scattered over the country, right? Over this around the city. So
Yeah,
that's
and also I think that's a great point because when I started looking at single family homes, I kept hearing that if one of your single family homes went vacant for a few months and you had to do a major turn to it, like a major renovation or something, all of your profits from that whole prior year could be gone. And so I found out with multifamily, let's say you have, an 80 unit property or a 100 unit property or 200 or 300, there's just all different sizes, but if a few people move out, then you're still able to pay your rent, your mortgage payment on your property, because all the other people are still paying their rent. So the scale of it is much less risky than it is with single family homes, which is the opposite, I think, of what people think.
yes, that is awesome. Yeah. And would you mind talking just a little bit about B and C class or what that means?
Mm-hmm. Sure. Yeah, there's really four classes: A, B, C, and D. And so A class are new properties that have been built like in the last 10 years, typically, or have been renovated to where they're really high end. It's going to be like the top end apartments that you could live in. And those are great for high earning individuals and, high earning professionals and all those kinds of things that want to live in an apartment versus a house. That's basically what that's for. B and C class are where most investors invest because B and C class is more like blue collar workers, workforce housing, that type of thing. So a B class is going to be older than an A class. It's still going to be nice, but it can be a good amount older property. Even to like 1970 or something, it could be brought up to a B class if it's completely renovated on the inside and the outside. And then C class is going to be a lesser quality neighborhood, typically a lower income area, but not a lot of crime. So C class, is going to be less expensive than B class. And, you can still fix it up and it can still be a great place to live, but it's going to be a less expensive option. And then D class is where we really don't ever invest because typically there's a lot of crime in that area and in that community. And it's very challenging to pull a D class up to a C class or a B class, where you can take a C and usually take it to a B. Ds are very difficult to pull up.
Wow, that is amazing information there. And I have a few questions from my audience. If you don't mind answering a few questions. Uh,
Sure.
and one person is asking, what is a typical minimum investment for an individual to invest?
Yeah, I would say the least that I have seen is 50,000. Whenever I started investing and looking at deals kind of all across the country with different syndication teams and ownership teams, 50,000 is the least that I've seen. That's typically going to be on a property that's not a super expensive property. Like if you're in the $10 million range or below, 50,000 is pretty common. Once you get above that, a lot of times the syndicators will raise the minimum investment to $75,000 or $100,000 because they're having to raise so much more money. The capital raise is so much bigger, and they just don't want to necessarily have that many investors in the deal. There's a lot of paperwork that goes into bringing an investor into a syndication. And then when you're doing distributions to these investors and K1s at the end of the year for the investors, there's a lot that goes into investor relations and managing those investors. So they tried to limit the number of investors they have when they get into, a $15 million property, 20 million, 25, and it can even go up. Sometimes there's a, $200,000 minimum or $500,000 minimum or $1 million minimum. But the bulk of the deals that the syndication friends that I have do are 50,000 or 75,000, sometimes 100,000.
Thank you. That is great information. And so on investments, like people coming into deals, what would you say like to a first time investor, or more importantly, like someone that has like their first 50,000, maybe they're young, maybe they've made their first 50,000, maybe how does that work? Like, is anybody allowed to invest?
Yeah, it's important to first of all, pick which team you're thinking of investing with, their general partnership team that you're looking at that's acquiring the property. So that's kind of step one, is determining which team you like. And then when they have a deal, do you like the deal? What we look at from the GP side when we're bringing investors in is is this all their money that they have? We don't want someone to invest all the money that they have. You know what I mean? They need to be comfortable with the investment. The investment's going to be tied up for typically 3 to 5 years, and it's not accessible. So we need to make sure that, this is like their extra money that they're investing. So that's kind of the first thing. We also do an investor call with them, and we ask a lot of questions to get to know them and their investing goals and kind of their financial structure. And part of what we ask about is whether they're an accredited investor or a sophisticated investor. And for 506B offerings, which is what we typically do, those are offerings where you cannot advertise to the public. You have to have all of your investors come in that have a pre-existing substantive relationship with you, with somebody on the GP team. So that's the offering that we typically do. There's also 506C, and you can advertise for those. So 506C, you must be an accredited investor. An accredited investor is someone who has a net worth of $1 million or more, not including their primary residence. So that's the first option to be an accredited investor, the first requirement. Or you can make $200,000 a year for the past 2 years if you're single, or $300,000 a year for the past 2 years if you're married, and you anticipate making that same amount in the next year. So one of those two things, if you qualify for those, you're an accredited investor, and you can go into 506C deals, which are advertised like on Facebook and just openly advertised. 506B is a lot more common, and you can be either an accredited investor or a sophisticated investor. A sophisticated investor is defined as someone who has enough financial and business knowledge to make an informed investment decision and to invest in the deal, in an informed way. But we can only take 35 sophisticated investors in any deal. So if you're a sophisticated investor, I would recommend getting in really early on deals as soon as webinars come out and the portals open up, and even soft commitment forms are sent out by investors when they're under contract originally before they've even had their webinar. I would recommend getting in your soft commitment, which is like your placeholder, because those sophisticated investor spots, those 35 spots, can fill up very quickly.
Thank you, Lisa. That is great information. And another question from my audience is, can I invest in apartments with my retirement funds?
Yes, and people do that frequently. I have several investors on my first deal and on the second deal that have used their IRA, and you have to get it over to what's called a self-directed IRA to invest in these deals. And there are different IRA providers. The one that we typically refer to is called Quest Trust, and they will set up an account. They move your money from wherever the IRA money is, if it's with a prior employer or wherever you have it, to this IRA provider, which is Quest in this case. And then you can use that money to invest in deals. Whenever the investments are made and any profits are made on the deal, let's say you start getting cash flow distributions, or when the property is sold, those have to go back into your IRA account. So they can't be sent to you. So yes, you definitely can. It's much better than having that money just sitting there and not being invested in a way that maybe you want. If it's not self-directed like this, you're not able to choose your investments necessarily. And I think getting your money out of somewhere that's barely earning anything and getting it into multifamily investments where you have, great capital preservation, great options for appreciation, and, even cash flow are great options for people with IRAs.
Thank you, Lisa. And that brings me to another question, or a thought on, like, do you invest in a fund, or is it like specific deals? And what makes you believe in these deals?
Okay. The fund option, there are some funds out there. And so there are teams that put together funds and they raise money from investors, and then they start looking for deals, and they already have the money just sitting there waiting to go in on deals. So that's a completely different model than finding a deal at a time. I would say a deal at a time is much more common, because the investor then can say, okay, I'm looking at this deal. I love this deal. I want to be on this deal. and then they can invest on that particular deal. And that's what I do. I don't have a fund. I work with teams that find specific deals. We underwrite specific deals. We match investors to those specific deals, and then they join on that particular deal. So that was your first question. What was your second question? Sorry.
Oh, like what makes you believe in a deal that, like, how do I, what makes you believe in a deal, the deal that you feel like you want to put your hard-earned money into, especially on a retirement account where maybe do you believe it can be more secure than like stocks or mutual funds or whatever a lot of people invest their retirement in?
Yes. I think just in general, real estate is so much more stable than the stock market. It's a secure, tangible asset. It's not floating in the air. It's a piece of land, with something on it. And with it being housing in particular, people have to have somewhere to live. So it's pretty stable through most environments, through economic environments. Multifamily in particular, though, through all the different changes that we've had in the economy over the last, 20 or 30 years, multifamily barely has a little blip when there's something that goes down, because apartment communities just in general are less expensive, to live in. If people can't afford their house, they move to apartments. If people can't qualify for a house, they move to apartments. If they're living in an A-class apartment and they can't afford that, they move to a B. If they can't afford a B, they move to a C. So apartment communities just in general are continuing to grow in popularity. A lot of younger people don't want to buy a house. They don't want to have the maintenance of a house and a yard and all the things that comes with that. They like to live in apartment communities, maybe near where they work. And then if they change jobs, they'll move to an apartment in a closer to their other job, their new job. It's a very kind of easy way, to live is apartments. So from an investor's side, I think just multifamily in general is such a great place to be for capital preservation, again, appreciation, and cash flow. So you're getting typically all three of those. Now, what I look for in a community when I'm looking to purchase one is more, what is that market? And is the market growing? And what is the job growth there? And are people moving into that market? And what are the businesses around it? And what other kind of apartment communities are around it? And what has been done to those? So assessing kind of the market first, trying to see what kind of business plan we could develop to add value to this property and to elevate the tenant base and to increase rents, because apartments are valued based on the net operating income, which is income minus, expenses, basically. So we're always trying to figure out, does this community have a great option for a business plan that we can develop and that we believe in? And can we add, reserve parking and charge for that, covered parking and charge for that, washer and dryer rentals? There's all different kinds of things that you can add, different amenities to the property that you can increase the rents then and increase the value of the property. So that's kind of the other thing, is the business plan. So the market, the business plan, and then just in general, the way you feel when you walk onto the property. Because from a design standpoint, we've worked on these for so many years, we feel like that feeling when you drive onto a property and when you walk into a leasing office, just that gut feeling of, I would like to live here. This is a great place, or it could be a great place. That's what we're always looking for, is it's not a great place maybe now, but with this, and this, we could change it and make it a great place to live. So I never go against that gut feeling of, I love this property. There are times that I've driven out to look at a property and I'm like, I don't like this area at all. And there's nothing we can do about this area that's around it. It's going to take too long to elevate this area, even if we elevated this one property. So we're looking at all those kinds of things from the purchaser's standpoint.
Great. Thank you. That is great information. And how apartments are valued, as you just mentioned slightly, how they're valued is different than single family homes, where you go by the comparable sold around where your house is located. Apartments are valued by the income, the net operating income, as you mentioned. So what's left over after expenses, and that's multiplied by the cap rate. and typically around 5%. And so that's how we get the value of the apartments. And that's amazing. That's amazing. It's
Yeah,
different.
it's so different from houses. And I don't think people really know that, in single family homes, they realize you can only raise your price as much as the comps around you have sold for. That's how you value single family homes. And multifamily is completely the opposite of that. It could be in a terrible area, but if you've done, great things to the property and it's full and you're getting higher rents and you want to sell the property, the sales price is based exactly on that net operating income.
Wow, that's good information. All right. And I have one more question here from the audience. And after that, we'll bring this to a close. So we pretty much covered this already. They're asking, why would I invest in apartments and why do you invest in apartments? We pretty much covered this already, but do you have any thoughts on that, Lisa?
Yeah, I just think once I started researching multifamily and learning more about it and learned how many people's net worth had gone up exponentially once they started investing in apartments, it's just a different animal. It was a world I didn't even know existed. I sort of fell down the rabbit hole in learning about it. And I just love the community. I think the people that have started buying these apartments over the last, 20 years or so are just regular people. They're business people who have been successful in a prior business. They're looking to preserve their, capital that they've saved up. They're also looking for, legacy or wealth building for their families that they have now. And it's just a great solution to get into real estate, whether you do it passively, like lots of people just want to do it passively. They have another job still. They just want to invest passively, know that their, investment is safe and that it's going to continue to grow faster than inflation. Like if you kept it in cash, inflation is just eating up your money every day. So getting it into something that's much more stable, I think is great. And then, planning for the future with what you want to do. A lot of people invest passively and then eventually maybe they want to be a general partner and they want to help manage the property and oversee the property and even oversee the property management company that actually runs it. But there are many that just stay passive investors and they might invest in 2 or 3 deals a year or 1 deal a year or 5 deals a year. It's completely up to them, but they know that their wealth is growing and their net worth is growing. Typically, we only keep these properties for 3 to 5 years. So it's a very quick turnover. Once that money is turned, like once the property is sold and, the money comes back with all the extra typically that, investors make, then they can put it into 2 deals maybe. So it's sort of getting that snowball rolling, starting out slow, just passively investing in a deal or two. And then before you know it, your net worth has gone up and up and up.
Wow, that's amazing. I like to think about how it compares, how this compares with like stocks and mutual funds and other things, other assets that we can invest in. And a typical, would you tell us just maybe a typical? I know we don't guarantee any returns, any specific amounts on any specific deals, but could you tell us approximately what you've seen, maybe a range from this to that, like how much the cash flow and the capital gains at sale, like
Mm-hmm.
how much you see typically or that you
Yeah.
feel comfortable investing in?
Yeah. On my very first deal that I invested in, it was a passive investment that I did. And they thought that the property was going to cash flow during the ownership of the property, but they had gone into a new market. The ownership team had gone into a new market and they just weren't as familiar with that market. And they weren't as familiar with the property management companies in that market and contractors and getting employees and things like that. So there were some challenges. They changed property management companies, like I think twice. Well, they ended up after 2.5 years selling the property. It never cash flowed the whole time. But at 2.5 years, I got my money back plus 40%. And I hadn't had to do anything. And I had I had bonus depreciation from that also because a cost segregation study had been done. And so not paying capital gains taxes on that is a big difference from stocks. In stocks, you're paying capital gains, where in multifamily, there are bonus depreciation options. And depending on everybody's situation, and they have to talk to their CPA, but it can be very beneficial from a tax perspective. But in general, I find that if people do hold the property 3 to 5 years, close to doubling their money is very common from all the deals that I've seen. So I think people love that idea of a 2x multiple in, just a very short period of time.
Right. That is very good. Yeah. So if you own, for example, if you own this, if the apartment was you invested in was owned for 2 years and you doubled your money, that would be a 50% per year. Or if it was held for 5 years and you doubled your money over 5 years, then what's that, 20% per year? So that's still a great.
That's really good still. Plus the tax benefits,
Right. That's something that people don't think about sometimes.
Yeah,
And that makes it more attractive than stocks and other types of assets that you can invest in.
right. I agree.
So, Lisa, is there anything else you would like to share before we bring this to a close?
I would just say it's such a fun world. I would just say jump right in and learn as much as you can, and take a chance. It's the people that sit on the sidelines and never do anything don't get to have all this fun that we have, and see their net worth grow. So I would say, find somebody you trust, find an ownership team, a GP team that you trust, and find a deal that you like, and jump in and get started.
All right. Thank you, Lisa. And to all those listening, please subscribe to this channel, Eagle City Multifamily, and see you on the next show.